So I wanted to talk about a new financial innovation that we are pioneering called the Extra Bond. Now, just to give it a little bit of context, so back in it was probably about 50 years ago now, corporate bonds took off like crazy. And a corporate bond was basically a tradable debt instrument that was issued by a company to raise money to go and do things. Now, when they realized they could do this, they originally called them junk bonds, but they've later been kind of rebranded high yield bonds. I guess it sounds a little bit better. But basically, they originally started to be used for acquisition, for M&A. And basically, it completely transformed the entire M&A landscape globally, led to some of the biggest deals ever done, led to some pretty sharky practices around M&A deals. But the basic concept was that you issue a bond, you raise a load of money, you use that money to go out and buy a load of businesses. And so it not only transformed the M&A world, it actually transformed pretty much the whole world, because companies then started to use that for massive infrastructure projects. So there are so many schools and hospitals, and I mean all of the internet fiber that's in the ground and under the sea was built using these corporate bonds. Some of the biggest companies in the world have done corporate bonds. Literally, spaceships have been shot into space, SpaceX, using corporate bonds. So they really have transformed the world in their kind of reach and everything else. And what we think we've created is a financial evolution to the traditional bond. You see, if you're a normal company and you want to issue a bond, there's quite a competitive landscape out there of issuers who you have to kind of sell your bonds against. So when you go to the distribution channel, there are basically two key drivers to get your bond distributed. The first one is to pay a high interest rate. So typically for a new issue, maybe double-digit interest rate to try and attract people to buy your particular corporate bond over somebody else's. And then the second one is obviously the distribution effort that you put into marketing the bond for sale, and how much you pay the distribution channel to go out and sell your bond. So typically that can also run into double digits. So unfortunately, that means that the debt is incredibly expensive, because if you borrow 100,000 and you're paying 10% a year of interest, well, obviously over 5 years, that's 50% on top of the 100 grand that you've raised. And then if on top of that, you've got a 10, 12, 15% distribution cost factored in, that's quite expensive. And then, of course, there's the process of listing it. So it's actually quite an expensive thing to list a bond. You have to produce a prospectus, get it approved by the exchange or the regulator, depending on what kind of bond you're issuing. So altogether, that basically meant that it wasn't really suitable for smaller businesses. Now, right now, there is a massive demand for both companies to sell, particularly retirement sales and the baby boomer generation retiring. And there's a terrific demand for companies to buy those businesses. And as you know, I'm all about democratizing wealth and trying to come up with solutions that meet small businesses' needs. Now, unfortunately, borrowing loads of money from banks to buy those businesses out is not very sustainable, because not only do you have a financial institution now that can pull the rug away from you at any time, you also have, the huge risk involved, the personal guarantees and all this other stuff that goes with it. So what we've done is we've created a product called an Extra Bond. Now, Extra Bond stands for X is exchange, TRA is traded, and A is acquisition. So Extra Exchange Traded Acquisition Bond. And so effectively how this works is it's a bond that's listed on a regulated market. So it's trading. You can buy and sell the bonds just like you can buy and sell stocks or shares in a company. So that means that the person who receives the bonds can sell them very easily if they want to. But the bonds are used for acquisition. They're used as the acquisition consideration. So instead of going out and selling the bond, raising the money, and then giving that money to the business owner, we just deliver the bonds to the business owner. They arrive in their bank account just like shares in a company would, or cash would, and they then sit there in their bank account and they pay them their coupon, their interest payment. So on the MBH bond that we've just issued, there are two classes. One is a 2% coupon, one is a 5% coupon. And the 5% coupon, for example, would just come every 6 months. You would receive your money. For most people, who are selling their business, the proceeds that they would receive, they would use to pay off their mortgage, maybe invest a little bit, maybe go and have some splurge money. Well, effectively with this, what they can do is they've got 5% coming in, which is actually probably more efficient than paying off their mortgage or investing. And if they want to have a splurge, they can simply sell some of the bonds and go, buy that midlife crisis car that they've always wanted. So the advantage is to them as well is that this is tier 1 debt. So tier 1 debt is the highest level of security within the company. So MBH Corporation has no debt. It doesn't have any liens or charges with any financial institutions at all. So the bond is the only debt in the company. So that gives them the highest level of security when it comes to their security. And basically they hold it for 5 years. They receive that 5% coupon every year for 5 years, and then they receive the capital repayment at the end of that period. So it's a very straightforward instrument for them. For MBH, it means that they've just issued 50 million of new bonds, which means they can go out and do 50 million of new acquisitions, which will add new cash flow, new profit to the group. Off the back of that, we've just announced an acquisition that's a company doing 800,000 a year in annual profits that's been added to the group. We'll also use these bonds to swap out the unlisted bonds that we gave to Robinson's Caravans last year. So that's again another million plus of annual profits that's coming into the group. So this can be used to scale up the profit and cash flow within businesses and really help them develop. So we think this is going to be a real game changer for companies, the ability to do this. So how does this help you? Well, basically the extra bond as a product, we can help any company effectively list an extra bond. They need to have 2 years of audited accounts, and ideally they should be listed. So we can do a direct listing process with them to get them public, and then we can do an extra bond issue for say 50 million or 100 million of bonds that they can go out and use to buy companies. So it gives enormous flexibility. It's another no money down strategy, and again a no money down strategy that enables you to target really big businesses. It doesn't involve any institutional debt, so you're not having banks or anybody else that can change the rules on you midway through your agreement and screw up the entire business. You are the issuer of your own debt, so it puts you in a very strong position. So yeah, if you think this would be interesting, we actually have a process just like with the direct listing process, where we can pay for the listing and they pay us effectively in shares. We can list the bond and they can pay us in bonds. So we've got the same type of no money down structure available to you guys if you want to do one of these in either a company you already have or a company that you're looking to use as an anchor to do a roll-up proposal or something like this. So we think we're the first people to ever do this. I actually pitched this idea to a private equity firm about 4 years ago, but they already had an asset-based bond, an asset-backed bond, so not a corporate bond. And we've been dying to do it ever since. And this is it's taken us about a year to put together, but we now know how to do it, and so we can do them much quicker now. It is a relatively quick, straightforward process. If you're already a listed company, it's a couple of months, 2 to 3 months, and you're away to go. And interestingly, if it's less than 600 million, it's considered a small bond issue. So you've got quite a lot of gas in the tank before you're considered big in the bond world. So yeah, drop any questions in the comments below. I'll happily answer anything. I might do a Q&A on this after we've done a few more deals and do a bit of a case study deep dive on it. But like all of our deal structures, no money down, no institutional debt, win-win for both parties, opens the doors to do fantastic, profitable, well-run businesses. Like I say, really suits retirement sales because of the kind of security available to everybody, and really helps the small to medium-sized business community as a new way that they can do deals.